Broadcast is now starting. All attendees are in listen-only mode.
Uh, Good afternoon, everybody. This is Manoj Abhichandani, and Happy New Year to all my listeners, and welcoming back to the auditing world, and expecting a lot of changes, especially in Division 296, and waiting for strategies to come out from various experts, and we would be discussing some of them. Before I start, can one of you kindly in your panel, in your question box, um, and just confirm that you can hear me? And also, I used up this break to learn a new software. So the presentation today would be very interactive. I noticed earlier that there were a large number of people who would switch on the presentation and continue to do other things. I believe this will not be possible. It will give you an opportunity to learn quite a lot, and it will be a very interactive presentation and something which you have never, probably some of you, but most of you would have never witnessed before. So let's kick into it and talk about auditing assets of SMSF. Like I said, it's a very interactive presentation. If you are using two screens, I'll request you to log into menti.com. You can also use your mobile phone, and you can scan the QR code on the bottom left hand side. And if you are able to enter the code 35158673, once you're able to do that, could you kindly, uh, on your Menti, you will be able to see a thumbs up. So if you can just click on thumbs up, and if you like what I'm doing, thank you for reacting towards it. I will really appreciate it. A lot of effort has gone into making this presentation. I can see the number of people who are attending is quite large, but not all of you have been able to log in. To get the full benefit of today's presentation, I recommend everyone to log in and enjoy the show. I can see that one of you has said that you cannot log in. Looks like you've changed your mind, so all good. But I still see a large number of you have not logged in. Now, let me just tell you, if you do not log in into Menti, your participation is very important. You will not be able to enjoy today's presentation, and you'll be locked out for quite a few slides. Okay, so this is a presentation where you will be participating equally with me, and it'll be a lot of fun. So I'm hoping that most of you are able to log in. If you do not have two screens, I suggest you use your mobile phone to log in. Okay, great. So I can see almost half of you have logged in, which is a good number. And as you will see on the top, I've entered the username the code and the website. So you will see that later to react to make a comment um, to some of my slides, you will need to log in. So let's just proceed and let's measure our current understanding. And I hope by the end of the presentation, I'm able to improve your understanding. Let's measure our understanding on the property valuation of and super fund till date. So in your Menti panel, could you please tick yes or no? So I'll wait for a moment. And if you like what I am doing, you can always go thumbs up. So I'm expecting some sort of a response from most of you. So the question is, property of the super fund can be valued by trustees as long as it is based on substantive data. So at the end of the financial year, we prepare a set of accounts, and the set of accounts uh, uh, are at market value. All the assets should be shown at market value. So the question is, do we need a professional? Do we need a valuer? Or can the trustees um, do a valuation for that property at the end of the year? Okay, so I'll just go on for another 5 seconds, 10 seconds, and then we'll move on. And the second question I'm requesting all of you to make a comment on: property can be held by the property custodian trustee when the super fund borrows. So I'm expecting responses on both. Okay, thank you very much. So let's look at the correct answers. And if you see um, uh, the center of the circle, a yes is blue. So the property can always be valued by the trustee of the super fund as long as there is proper comparison. So let's say you have a unit in Castle Hill in your self-managed super fund. Trustee can say it's a two-bedroom unit on the fourth floor and it's a 20-story building. So the trustee can compare the fifth and the sixth floor with second and the third floor and say that these are the recent sales made. And in my opinion, this is the valuation, this is the market valuation of the property which is owned by the super fund. So that's possible. So hopefully by the end of the presentation, we are able to convince these four people to change their opinion. The second is, property can be held by the property custodian trust when the super fund borrows. So as far as the ownership is concerned, if you look at section 67A of the SIS Act, it clearly says that when the super fund borrows, the asset must be held by another entity for the benefit of the trustee of the self-managed super fund. So in all cases, whenever the super fund borrows, the property must be held in the name of the trustee of the Bay Trust. And hopefully during the presentation, we will be able to discuss how this happens. Now, I can see that you are raising some questions. And one of the questions which has come up is, where is the code and how can you put in your opinion? If you will see on the top of my slide, you have to log into menti.com and enter that code, and you will be also able to participate in this presentation. Okay, now moving forward, um, let's look at a different situation, um, and let's look at what all I'm going to talk about today. I'm hoping that most of you are auditors and will be, or if you're not an auditor, you are a trustee of a self managed super fund, or you are an administrator and you are getting the fund audited by an auditor. I'll be talking about verification of assets, how uh, an auditor can check whether the super fund actually owns that asset on the balance date 30th of June, and to check whether it is really held by the trustee of the super fund or not. I will also talk about how will the auditor check if there is a mortgage on the property, and we will be talking about title deeds and SIS regulation 13.14. By the way, SIS regulation 13.14 is in your audit report, and each and every auditor must comment on whether there is a mortgage, whether there is a charge over the asset of the fund or not. We'll also talk about the go-to solution for super fund auditor. He must have a look at the title deed of the property, of all the assets, of course. We will also look at the Australian auditing standards. What are the requirements, and what they tell us, how they guide us in looking after the property aspect, or by checking or by auditing the property of the self-managed super fund. Now, I can see that not all of you are still registered. If you are not, just providing you on how you can interact in this presentation. If you have another screen, or if you have a mobile phone, you will be able to scan the QR code and then enter the code 35158673, and you will be able to participate in today's presentation. So let's look at the type of assets a general self-managed super fund can have. It's always a bank account. You can have ASX, Australian Stock Exchange, shares, or you can have managed funds, ETFs. You can also have unlisted shares. So you can have unlisted managed funds. You can have the cryptos, and there's a new asset class which has come up, which is called NFTs, which are non-fungible tokens. It's basically a digital history of an event. So if Michael Jordan jumped up and there's an official to score a basket in history, and that evidence is stored in a digital format, and you could own it. You could own gold bullion, or you could have overseas shares, or you can have overseas managed funds, and you can have collectibles, and they're sometimes also called personal use assets. And the classifications is basically art, wine, cars, and other collectibles which you can own. And then everybody's favorite, you can own residential and commercial property in a self-managed super fund, which can be in Australia, or it could be overseas. And there are various types of residential properties. There are studios, townhouses, villas, units, houses, or they could be a block of units. So there could be multiple types of residential properties, and also there could be multiple types of commercial properties like an office, industrial factories, retail shops, petrol pumps, you just name it. There's lots and lots of types of commercial properties, and there are more of them coming along as we move forward. So this is the time when, yeah, again, if you're logged in, my question to you is, can you type in what you have seen in super funds which you have audited? What type of crypto or NFT or gold bullion you have seen? So one of the possible answers which you can type in, if you look at your Menti, if you can just type in various types. Okay, so some you have not mentioned. So you've seen crypto, gold, yes. So bullion certificate, so that's a new one. NFT artwork, okay, that's good. Crypto and gold bullion, but crypto, could someone just go into different types of cryptos? Silver bar, gold, that's excellent. Okay, none in your experience, that's good. So you're trying to avoid those type of people. So gold bullion is quite common, gold bars is quite common, and it could be quite difficult sometimes to audit um, these kind of assets, and we will talk about it as we proceed. Now, let's just move on and discuss what problems you can have if there is a crypto in a self-managed super fund. Sometimes the asset is not in the name of the super fund, but nowadays the crypto exchange is very, SMSF friendly, and usually they can have some sort of account in the name of the super fund. But even if you have the account in the name of the self-managed super fund, the wallet, the username and password is only with one individual trustee. So that means the control is only with one person, and that's can be a problem, because if that individual dies all of a sudden, then nobody can access the wallet, and that asset can be literally lost. So the valuation is not that simple, because there are on count about 300 very popular cryptocurrencies, and in all there are about 1400 different types of cryptos which are available. And one of the very comical one is doggy, where someone for fun started that coin, and in fact it has an intrinsic value. So people are accepting and buying and selling coffee beans and things like that in the US. So it's sometimes difficult, because the valuation of the asset fluctuates, and there are sometimes too many transactions happening within that wallet, and to check and track each and every transaction, it could be quite difficult for a trustee, for the administrator and the auditor to check those transactions. Now, we could just going into the last slide. If there are these problems, then as an auditor, if you cannot authenticate by a third party, then it results in a Part A qualification. So if it's not audited by a third party, that actually so many cryptos are held in that wallet, it creates a doubt in the mind of the auditor, and that results in a qualification. And if you're not qualifying uh, all those funds, I highly recommend that you should look at it seriously, because I feel that the audit report should be qualified. And if you know that since 2019, uh, the tax returns needs to be uh, the tax office needs to be alerted, the tax return needs to be marked whether there are any Part A qualifications in the audit report. All right, so moving forward, I will ask you for your opinion. And do you see overseas shares and managed funds in self-managed super funds which you audit? Okay, so you can see that quite a few people are seeing a lot of people going into, usually they go to the US and they buy, shares and managed funds which are overseas. And it's quite an interesting thing that we are witnessing. And I remember some years back when in 2018, when we had the GFC and the American market just collapsed. And when it collapsed, we noticed that a lot of trustees were going to America. I'm buying American properties for $10,000, $15,000, like if they were dirt cheap. And people were traveling to US and buying them, buying not one, two, but multiple properties, and they benefited quite a lot. So this is quite popular. I still notice that some of you are not logged in. If you have not logged in, just to mention, if you want to participate in this presentation, you can log into menti.com. And once you log into menti.com, you enter this code. And once you enter this code, you can make a comment and you can join the fun. All right, so let's look at some other situation. Uh, do you see collectibles, art, jewelry, wine in your self-managed super fund? So earlier on, if you remember, we looked at a slide where we see crypto. So crypto is not that popular, and we saw that not many of us saw them. But as far as art, jewelry, and wine are concerned, they are now exiting the super fund. And the reason they are exiting is, I would like to say, in 2016. Thank you very much for forming your opinion and giving me the feedback. And I hope you are looking at the screen and not doing other work while last year I was presenting. And this interactive method would be continued in the future so that we can collectively see what other people are also thinking and we can have some fun together. Okay, so the problem with collectibles and personal used asset is that uh, you know they have to be, these rules came in 2016, and we said that these cannot be, section 62 was a problem. It wasn't for personal use, it wasn't for present day benefit. They cannot be leased to, so you can have a beautiful painting in your self-managed super fund, but they cannot be leased to a member of the fund or to a relative of a member of the fund. So these were always a problem, and they could not be stored or displayed in a private residence. And that really dropped it, and we saw that a lot of people were actually selling these to themselves, or the super fund was selling these assets at market value to members and relatives of members and things like that. So this continued quite a bit in the past, and that was a good thing. And what if you see them and in your self-managed super fund, and we saw that almost 50-50 percentage saw that you will see these kind of assets in a super fund. Technically, you will have still a problem. So just going back, you will see that you still have to comply with the sole purpose test. That is, the present day benefits are not allowed, and documents where you have to correctly show it to the auditor where these collectibles are stored, and you must insure them. So if you buy any of these things, and I've seen people buying vintage cars and you store them, and the storage is quite expensive, you must also insure them. And if you are selling it to a related party, you have to make sure that there is a proper market price on received by the super fund. And the auditor must check whether there is any lien over it, because as an auditor, we still need to look at SIS regulation 13.14, and we must look at the PPRS register to check whether there is any loan or anything on this. So the next I want to know is, do you see property in self-managed super fund? And then as you can see, that a large number of you see a lot of trustees investing in property. Um, you may have a different type of investors or the investment strategy of the fund. But generally, I have noticed that they are skewed towards one way. So a trustee could generally be, inclined towards shares, or generally the trustees inclined towards property. And sometimes I think that if you are setting up a new self-managed super fund, and because in trust deed we see a lot of new incorporations happening, so you usually see that a self-managed super fund is created, and soon after you will see that a property custodian trust is purchased by the same self-managed super fund. And I look at the sole purpose test, and I look at section 17A. 17A says that the sole purpose of setting up a self-managed super fund is for retirement benefits. But what the member is actually doing is he's buying with borrowing a commercial property, a retail shop, which can be leased back to the member, which is obviously legal. But the purpose of the fund, or the purpose of setting up the self-managed super fund, is getting a little bit blurred, because the purpose of the super fund is for retirement benefits, but the purpose is all of a sudden becoming to buy this commercial property, which can be leased out to a related party. So moving forward, could you tell me what type of property do you see in self-managed super funds, which you see? Do you see a lot of residential property, or do you see a lot of commercial property, or do you at times see overseas property? And this could be really interesting, because Australia has um, a lot of people from overseas who have become trustees of self-managed super fund. And sometimes they think, oh, I have parents, I have relatives overseas, so why not buy a property overseas? So as you can see, we have a large database here, and they are all talking about more residential and commercial property than overseas property. But let's look at the problems or implications which the auditor will look at whenever they see properties overseas. You'll need to go really deep into it and make sure that there is a lease to an unrelated party and not to parents or children or brothers and sisters living in that property. And also, you have to look at the double taxation agreement which Australia may have with that overseas country. And then, if there is a property and if rent is coming, tax may be paid in that overseas country. And then the agreement is with individuals, the double taxation agreement is with individuals and not with self-managed super fund. And then you're talking about foreign tax credit being claimed in the self-managed super fund for that property. And you will notice that many countries do not have the same financial year as 30th of June as Australia does. So the question then comes is, when can we claim the foreign tax credit? And the answer to that is very simple. It's in the year when the tax is actually paid in the foreign country. Um, Many trustees I've noticed have actually ventured out and lent money, their own money, to the self-managed super fund. And when they lend money to the self-managed super fund, we look at the rules of those countries, because they could be non-residents. So usually a Filipino will go and buy a property, with his self-managed super fund in Philippines, or somebody coming from South Africa will, a non-resident South African will go and buy property in South Africa. And then if the self-managed super fund does not have enough money, then they will lend money to the self-managed super fund. And when you lend money to the super fund, you have to charge interest. And in South Africa, I know once you leave the country, it can be held only in the name of the trustee of the person who was departed. Even in India, that is the rule. Only non-resident Indians can own property. So now you have a Bay Trust where the property is held in the individual member's name, whereas it is not the individual member's property. The property is actually owned by the self-managed super fund. And that's a contravention again, because the property should be held in the name of the trustee of the self-managed super fund. And if it's a Bay Trust, so you have to actually comment whether the foreign country actually does not accept uh, a Bay Trust, because it accepts only the individual who used to live in that country as a non-resident to own the assets. The next problem could be QS reports, because now that you have a property overseas and you want to claim a capital works deduction under Division 43, and that could be a problem because the QS report is not available, and you see a huge claim for depreciation. So, so this could be another issue which you need to, sort it out with the administrator. And your answer as an auditor is very simple, that if I don't like it, I'm just going to contravene it. If I don't understand it, I'm just going to let the tax office know that I don't understand it, which means that I cannot lose my license as an auditor, which is good enough for the time being. Let's look at the legislation. What does it say? And 6 SIS regulation 4.098.2, which I have replicated here, says a trustee of a regulated superannuation fund, that is a self-managed super fund, must keep the money and other assets of the fund separate from any monies and assets held by the trustee personally or held by the employer or his associates. So it's very clear. And by the way, all of you auditors, you see that part B of the audit report. Your question is, does it matter? It really, the answer is yes, it really matters, because in the audit report, you see those little numbers in the part B in the compliance section. It's very clearly mentioned that 4.9a. So it's the auditor's duty to actually check whether all those assets are held in the name of the super fund or not. And the tax office in 2014 made it very, very clear that a self managed super fund should have a separate bank account altogether, because in ATO ID 2014 stroke 7, they wanted to test that there is a related trust, and the related trust actually owns a property, and the rent is coming in from an unrelated party. So why we have to collect the rent in a bank account owned by the related party? Why can't the self-managed super fund share that bank account with that related trust? And in 2014, it was clearly mentioned that self-managed super fund must maintain its own bank account. So, in repeating what 2014 stroke 7 talks about, that if you have a related unit trust, it must have its own bank account, and self-managed super fund must have its own bank account. And it must keep its assets separate from other entities. And since unit trusts are associates of standard employer according to Section 12 of SIS Act. So all the related trust must have uh, their own bank account. Okay, let's play this game again. And my question to you is, what is important for an SMSF to keep their assets separate? So I've got 1, 2, 3, 4. So you have to decide which one is more important for you. So if you look at your panel and form an opinion, so I'll give you some time to do that. So I'll give you 1 minute to go through all of these and form an opinion. All of them are important, but we are just making a decision on which one is more important. So, um, to keep the assets separate. All right, so we still got 30 seconds left to respond. Um you can change your numbers, and we can see. So all the 4 points are very, very important, but we need to understand what do you think is more important than the other. Okay, we've got last 10 seconds to go if you want to change your mind. Okay, excellent. So most of you agree that the self-managed super fund must protect the assets by establishing a clear ownership, and that's really important. We cannot have members' names on the asset. It should always be the trustee's name in trust for the self-managed super fund. So when we say that is self-managed super fund a unit trust of some sort, and if you really think about it, that we can have between 1 to 6 members, and the trustee is the trustee which is owning the asset, but for these unit holders, because each member has his own member balance, which keeps on fluctuating. Whereas in a unit trust, they may have one set of units which do not keep on changing, but in a self-managed super fund, it's flexible. It keeps on going up and down depending on what contributions are made, and if they are pensioners, if they are withdrawing any pension from the fund, so their units keeps on changing. And if you look at public offer super fund, what they do is, and some of them do it on a weekly basis, because people are withdrawing money, they're rolling over money. Every Wednesday, what they will do is they will convert all the assets to market value, and they will have a unit price. And if you had so many units, and they can go into 5 decimal points, and if you had so many units, your super fund is worth so much on that week. And just a point to note out here, that if you have a corporate trustee, and if you have to add a member in the fund or someone dies, at least you don't have to change the title of the asset, because the title is always held by the corporate trustee of the fund. So it helps a little bit. So it's quite important. And if you are an administrator out there, or if you are a trustee of a self managed super fund, you should really think about converting the fund into a corporate trustee if you already have individual trustees, because maybe the client is not going to add a new member, but it's possible from husband and wife, one will die first, and then you'll have to worry about changing the title of all the assets of the fund. So it's a good idea to get it done now and over with it. And if you're thinking of setting up a new fund, it will be always a good idea to set it up with a brand new corporate trustee, where the sole purpose of that corporate trustee is to act as a trustee of the self-managed super fund. And of course, we know that if the assets are not held correctly, the auditor will lodge a contravention report to the ATO, and you see that the trustee then gets disqualified, and once he becomes disqualified, he can no longer be a member of that fund, and he has to then roll out the money out of that self-managed super fund. Now, I've noticed, and a lot of auditors come to me when they get caught uh, in a situation where the auditor has lodged a contravention report that the assets are not held. 4.09a is a very popular contravention, and then the trustee, is disqualified, and the whole thing gets back to the auditor. And then the reason the auditor actually, is caught is because the asset is not held properly. So most of you are picking up that if you have a bank account, it it's in the name of the corporate trustee, but we should also have that it is holding that asset on behalf of the self-managed super fund. So that's the key to it. So Obviously, just holding the asset in the name of the trustee is not right. It must always be in the name, and you won't be. You'll be really surprised how many auditors get caught with this kind of a problem, and they either fail to notice it, and sometimes they don't look at all the bank accounts because there could be multiple bank accounts in that self-managed super fund. Um, if you're really enjoying this presentation, I would appreciate uh, your reaction, and thank you for all the thumbs up. And thank you for appreciating that. A lot of effort has gone into making this sheet so that you actually learn something. And I've attended so many presentation by other people, and sometimes they put you to sleep. And I've noticed in SMSF school that can happen. There are some speakers who are really dull, and what I'm trying to introduce is a different level of learning from 2024. All right, thank you so much for your appreciation. I really like it. Okay, so let's just see which one is better. Now, I'm assuming you are trustee, I'm assuming you are administrator, I'm assuming you are an auditor. Which one is better? A trading entity as a trustee of a super fund, or a sole purpose non trading entity as a trustee of the self managed super fund? Okay, I must confess here, my self managed super fund was set up in 1990. And in those days, creating a separate company, ASIC used to charge $800. And by the time you board it, it used to be $1,200. And I already had a company, and being an accountant, um, I had this Abhichandani and Associates, which was a registered tax agent. And I thought, why do I need one? So I ended up having a trading entity because there was a property in the fund. And then, I did not consider that it will be wise to change it at that point of time. So I still, till today, and thank God that now I'm no longer a tax agent, I do not have Abhichandani and Associates as a trading entity anymore. It has now become a sole purpose, non trading corporate trustee. But it's a good idea to have a non trading entity because there'll be no confusion in the future whether this asset actually belongs to the trading entity, and the creditors, will not be able to, when they do the search on what does the company own, what does the what's inside the company when it goes into liquidation or anything like that, the asset of the super fund is then protected. But I've noticed, if you have an asset in the super fund, even if it is a sole purpose corporate trustee, the asset, like the bank account we had ITF in trust for, property in New South Wales cannot be in the name of the self-managed super fund. You cannot have ITF. So I'm going to ask you a question. If you're an auditor of the fund, and if you see a fund with a property in the name of one member of the fund, what will you do? And this is the answer which you have to type in into Menti and give me your opinion. So this will require looking into your phone and trying to decide what will happen. You see a property. So I'll just give you some more time to think about it on, and you should also think about once you have decided. So I'll just uh, go on for 30 seconds more, if you allow me. Um, okay, so we still have about 15 seconds. You can put in multiple comments. So if you're the auditor of the fund and if you see the fund with a property in the name of one member of the fund, what will you do? Will you try and rectify the situation? Just think about that. Will you suggest that they sign a declaration of trust? Can the member be a custodian on behalf of the self-managed super fund? Okay, so now you see you got more time, and now I'm talking about it. About declaration of trust and acknowledgement of trust, and we earlier on thinking of contraventions, but then since we are auditors, we can give them a solution that now that you have the property, which is which is actually the real owner is the trustee of the super fund, but it is in your name. um, there is also a school of thought that you must audit what you see, and if you audit what you see, then obviously contravention is the solution or is the only answer. But then there is another school of thought that I will question the client that why did this happen? Because it's possible that they could be in some years back before you were the auditor, they were individual trustees and then they changed it to a corporate trustee. Or in New South Wales, for example, uh, the property can be only in the name of the trustee of the fund. You cannot have ITF. So, since there is no declaration of trust produced to you, perhaps you could ask them to prepare an acknowledgement of trust, and the difference is that a declaration of trust is entered before you purchase a property, but an acknowledgement of trust is prepared after you have purchased the property. So contravention is not always the thing which you will resort to, because what contravention does is it alerts the tax office, and if you alert the tax office, then the trustee can get disqualified, and if the trustee gets disqualified, then he has to roll out the money and then perhaps even close the fund. So before you actually jump, and I remember, training a junior when I used to be in practice, whenever there was something wrong done by the trustee, oh, this is a contravention and this is and they used to get very excited. Oh, I found a contravention in the fund. Sometimes your an auditor's role, I think, is to collaborate with the administrator. And that is why I always tell an administrator that it pays to pay more for the auditor, because if you pay more for the auditor, you will get a good auditor. And if you get a good auditor, the good auditor can actually help you to administer the fund in a better way. But if you get a cheap auditor, the cheap auditor will not have the time and will not have the skill to help you to administer the fund in a better way. So, an asset of the fund could be an insurance policy, for example. And if it is, and this is what you will see, that there is a life insurance and the beneficiary is the spouse of the member and not the self-managed super fund. So what you will see is that the payments for those life insurances are being paid by the self-managed super fund. So you have to be um, um, really be very careful on what can be fixed or not, because you have to still lodge a contravention, but a contravention can be lodged in a way that you fix it or get it fixed. And once you have got it fixed, then you lodge a contravention, and the contravention you say that although on 30th of June this was wrong, but I intervened and I got it fixed. And Bruce, thank you for your comment. And you say that what about the breach of independence? I really respect that, because an auditor must be an independent person and he must audit what he sees. That's absolutely correct, and I totally agree with you. But you should look at the longevity of the fund, and you don't want the fund to, for a small error, and it could be a human error. Like I said, there could be individual trustees in the past, and now we have a corporate trustee or a new person has been added. So that error should not be such a large error, or should not be a slap on the wrist could fix things, but it should not be you should not think of shooting the fund and killing the fund in the process by lodging a very powerful contravention. Well, this is just my opinion, but there are two schools of thought, and I leave each one of you to decide which one will suit your purpose. Okay, let's move on and let's look at, is it the trustee's job to hold assets? Will you lodge a contravention report to ATO when? And I'm giving you the situation, and I'll let you read all of these. So I'm asking you, uh, is it the trustee's job to hold assets? And will you lodge a contravention report to ATO when the trustee has not consented to be the trustee of the super fund? So have a look at your mentee and give me your opinion. So you have to comment on all four of them. So I'll try and explain the question in a different way. So is it the trustee's job to hold assets? Because we, in the previous slides, looked at that all the assets of the super fund must be held by the trustee of the super fund. But what about a person? Let's say there are two trustees. The other trustee did not consent to be a trustee, although on paper they may be a trustee. So the trustee consent form is not there. So that's the situation I'm looking at. And he did not sign the ATO trustee declaration form, which is required by Section 104A of Swiss Act. So he never said, I will look after the fund. He never agreed that I will be the guardian of the assets of the super fund. So what I'm going to do is, it's a little bit complicated, so I'm just going to allow another 30 seconds for you to respond. Uh, I'm noticing that some of you are skipping to answer this question. Look, you're not going to be passed or failed. We're just getting your opinion. So just think. Okay. So if the trustee has not consented, to be a trustee, if a member has not consented to be a trustee and he's already breached 118, and you must remember 118 is not in your auditor's report. You're not supposed to check, but you're supposed to check whether all the minutes are there or not. And you're supposed to check 104A. So he must have signed the ATO declaration. So, what is the correct answer? Let's look at that. So, you will see in the middle of the circle, if it is yes, so the contravention should still be lodged, whether he has consented to be a trustee or not, because since he is a trustee of the fund, he has to, we as an auditor must lodge a contravention. And um, whether he has signed the ATO declaration or not, a contravention is still to be lodged. Now, let's look at a situation when the trustee goes overseas and it is now the LPR who is the trustee of the fund. So, what happens in this case? So, you know for a fact that once the member goes overseas, the trusteeship of the fund is changed. So we need to make sure the LPR also has signed the ATO trustee declaration when the LPR was nominated to be the new trustee of the fund. And let's look at a situation that the member has died. Let's say it could be um, a two-member fund, and there's a property in the fund, and one member dies and the spouse is still alive, and the asset is held in the names of both the members. So will you lodge a contravention? uh, the answer could be yes or no, because it depends on when the person died and have 6 months passed or not, because the remaining trustees actually get 6 months to fix the issue. And if 6 months have lapsed, so let's say a husband wife are members of the super fund, the husband died, and you are auditing the fund, let's say today, which is January the 15th or 16th or whatever it is, and let's say he died on 30th of June 2023. So the wife had actually 6 months to fix the issue, and she fixes it by having a corporate trustee where she's the only director of the corporate trustee and she's the only single member of the fund. But the only thing which she has not done is the asset of the fund is still in the name, let's say the bank account of the fund, or all the shares of the fund are still in the name of the two individual trustees. And now you are auditing the fund on the 16th of January. So 6 months have passed. And if 6 months have passed, then you must lodge a contravention report and let the tax office know that all the assets are not in the name of the trustee of the fund. So the period of the audit, the timing of your audit will decide whether you will lodge a contravention or not. And that's probably why that some of you are agreeing with me and some of you are disagreeing with me. I'm not saying one answer is right. What I'm saying is the timing of the audit is paramount decision maker whether contravention should be lodged or not. Now, some assets we know cannot be in the name of the super fund, and especially in New South Wales, can be held by the trustee only. And if you look at the GS 009, it clearly says that the ownership must be established, or a caveat or a declaration of trust must be done, or a declaration of trust should be entered. But we looked at your opinion whether a contravention is necessary or not, and if no declaration of trust is provided or no acknowledgement of trust is provided, what are we doing? Are we letting those trusts go, letting those self-managed super fund, go without a contravention, and that could be a serious matter for you to consider, because your license could be on the line. And if they haven't got a self-managed, if they haven't got a declaration of trust or acknowledgement of trust, you could always go to trust deed, because acknowledgement of trust can be purchased at any time, and you will see that this acknowledgement of trust is available from the website for $275. It's a cheap price to pay instead of lodging a contravention. And we must also look at the penalties which will come because of Section 34 of the SIS Act, because it's not only that the trustee can be disqualified. The trustee can also pay penalties, which are, well, the penalty increased to $200, so this has to be updated. So you could be up for a lot of fine to be paid. So it's better to have an acknowledgement of trust in place. All right, so let's just move forward and educate the trustees a little bit more. Now, let's look at a Bay Trust situation, uh, and we know that in Section 67A, Superfund is exempted to borrow, because Section 67(1) clearly says that self-managed super funds must not borrow, but Section 67A says yes, the super fund must borrow as long as the asset is held by someone else in trust for the beneficiary of the trustee of the super fund. And if you look at Section 71(8), now, let's assume a situation that the super fund borrowed money and for a property, and then we were receiving rental income, and we were making contributions to the fund, and we paid off the loan. Can we continue to hold the asset by the property custodian trustee? And the answer to that is in Section 71(8), 71 bracket 8 and 71(9), because what it says is that an asset of a super fund investment in a related trust is actually an in-house asset of the fund if it is borrowed. But it says if the related trust is in section if it is in Section 67A, then you are more or less covered, and then it doesn't become an in-house asset, and it can continue to hold even if the loan is repaid. And even in my self-managed super fund, I had um, a related party lending to my self-managed super fund, and I have a Bay trustee which continues to own the property which actually belongs to the super fund, and the tenant is paying rent to the super fund, but the loan has been repaid with contributions made by various members of the fund, but I have not transferred that property to the self-managed super fund. And the reason I did not transfer is because the solicitor quoted me $3,000, and there is stamp duty of $500 to be paid. That's the only reason. Why should I pay when I can hold that asset, continue to hold that asset, and in the name of the trustee of the property custodian trust? And the only loss which the self managed super fund has to pay is to pay the annual review fee to ASIC every year, because the trustee of the property custodian trust is a corporate entity. So, with $300 or whatever that figure is, the trustee of the PCT can continue to own the asset of the self-managed super fund. Now, having said that, anybody can be a custodian. So let's say you go and buy buy let's say a vintage car, and you buy it in the name of the member of the fund. And to buy the vintage car, you lend to the super fund, although the super fund had most of the money, but you still lent $1, and it was bought by the custodian, and the custodian is the member of the fund. So the $1 loan was repaid, say after 6 months, or $100 or $100,000 was paid back to the lender, and the asset is continuing to be held because Section 71(8) and 71(9) says that it is not an in-house asset of the fund. So it's fine. So there is no problem in a custodian owning the asset of the fund. There's another exception, and if you look at ETFs and if you look at CFDs, contract for differences, you will notice that in contract of differences, the issuer is the one who is holding the asset of the super fund, and not the super fund itself. Now, if you look at Regulation 13.14, there are charges over the assets of the fund, and it says that for Section 31, it is a standard applicable for the operation of regulated super fund and approved deposit fund, subject to 13.15. A trustee of a fund must not give a charge out. So, how will we, as an auditor, ensure because we are supposed to audit the fund according to the Australian auditing standards. And auditing standard 500 says that you should have sufficient appropriate audit evidence, and specifically the auditor should design and perform audit procedures which are appropriate to the circumstances. And if you look at AS 500 paragraph 9, it says when using information produced by the entity, the auditor should evaluate whether the information is sufficient and reliable for the auditor's purpose. So let's look at a real life situation. You are auditing a fund, and the title deed is provided by the administrator. Okay, so as auditor, and the property is worth at least 50% of the asset of the fund. So let's say it's $1 million property, and it is $500,000 or more property in $1 million fund, and the PDF of the title deed is provided by the administrator. Will you consider, or will you accept it as sufficient appropriate audit evidence? That is my question. Okay, and I can see that a PDF file, I mean, there could be a charge over it, there could be a mortgage over it, there could be a caveat over it, and that can be easily erased. I mean, a PDF file can be uh, doctored or can be amended. And if you remember, recently there is a case, and it came in the news also, about the Cadix case. What she did was she was swindling all the monies of self-managed super fund, but she was doctoring the PDF file to show to the auditor that all these assets are actually held in ComSec. So she had a ComSec PDF file. All she was doing is changing the name of the fund every time. So whatever, in fact, you must have a trustee representation letter to say that the PDF which you are sending to me, I'm relying on that PDF and that PDF is correct. But something so substantial where it is 50% of the asset of the fund, can you trust the trustee or can you trust the administrator? And the 12 people who have decided to trust them, I will say there is no need to audit, because the point of auditing is defeated, because if they are making judgment, if the administrator is judging it, there is absolutely no point continuing with that audit, because it doesn't give any conclusive proof. So what we have done is, in online SMSF audit, if you look at that, if you are a member, if you are using this software, you will see that we have built a new tool where you can audit, where you can order title search on the website. And I'll show it to you with in my account. There is a fund which is called a test fund, and if you go into tab A of your software, you will notice that we have a section where you can check all the searches of the fund. You can make an asset search, a residential valuation, and all of that. But in part 5, you can actually, and we give you a price guarantee. So just make that a little bit bigger so that we can see the whole screen. So we actually give you a guarantee that if you find it cheaper elsewhere, please let us know. But these are the prices, and um, um, what you're supposed to do is enter by either address or by folio number, and you will notice that in Victoria there is a difference, because the Victorian government, the treasury, allows you to search with a folio number and charge less money to us. So what you do is, I'm going to just enter my address and see that we have all the addresses of Australia. So what you're supposed to do is look at the enter the address, and then you can add more if you like. You have to agree to the terms and conditions, because our and it took us almost 3 months to build this, because all the 7 governments were very, very keen to have their terms and conditions displayed to all of you. And once you go in there, you will see that every state has their own terms and conditions, and we have to make sure that you agree to all their terms, especially the privacy situation of their use of their data. And then you can proceed to payment. And once you pay, what we can do is, we can provide you with a title search of New South Wales, Queensland, and Victoria, which is instant, because we have an API with them. As far as the other states are concerned, we do not have an API with them, and we can provide them within 2 hours. So by the time you complete your audit, or you come in the next day, you will have your titles deeds delivered to your inbox, and you will be able to download it from the delivery page. And we will also add it in the audit evidence of the year. So you'll get an email, you'll get it in your delivery box, and you'll get it in your audit evidence as well. So with that, I'm almost done. I know I've taken longer than normal to present this unique, or your first time, but I'll really appreciate going forward your opinion on what you think. Would you like this interactive type of presentation, and or just give me a little bit of feedback, because it takes a bit longer to present in this manner, but it's really engaging, and it's fantastic as far as I see it, because it gives you an opportunity to the attendees to make some kind of a contribution, and it's all about learning and learning together. And I'm happy to be the moderator of learning with every one of you. And I want to thank all of you for being with us today and participating in today's presentation. And I hope to bring in more interesting conversations, and I want to help you further in your journey of being a better auditor. Thank you very much. So, as far as questions are concerned, I can see, from Menti, you can download the presentation. So you just have to enter your email ID, and you can download the presentation from there. I can see that there are some questions which were put up, um, and most of them are related to Menti. I think it's your first time, so I guess it's a first time for me as well. So I have a question from Natalie, and she says, with the crypto, can you disclaim an opinion instead of qualify, stating the audit is based on the crypto documents received? Look, you must be able to, for part A, you must be able to verify from a third party. And if you're not, I believe Coinbase is the only platform which can verify it. But if you have any other platform, then you'll have a problem. So you must qualify part A. Uh, I'm looking at another question by Jenny, and she's saying that the property owned by that member be deducted from that member's account. Okay, would the expenses relating to the property owned by that member is deducted from that member account? I'm not able to. Maybe it was based on that slide, so we've moved on. So I'll just carry on looking at some questions. Okay, I am also watchful of the time which we have extended by. So thank you very much again, and thank you for being with me. I would like to close this presentation for now. Bye.